I'd like to thank the organizers for inviting me to discuss Craig's important and timely paper. I should give the usual disclaimer that the views I'm about to express are my own and not those of my employers. And in the interest of trying to keep us a little closer on time, I'm going to skip through the brief summary of Craig's paper. I think he did a fine job doing that, and get to the conclusion, which is, taken from the paper, the case for mandating clearing is extremely dubious. I think in terms of raising doubts, his paper is a smashing success, so to speak. But my principal comment on it is that it only lightly touches on the central issue in the debate, the role of implicit government guarantees. And I think these need to be in the model for it to draw firm policy conclusions. Now, to be fair, the discussion did note that the central counterparty creates the sort of interconnections that encourage bailouts. And he didn't talk about it here, but in the paper there was a fair amount of discussion arguing that dealers face substantial discipline, so the issue of implicit guarantees is not ignored. But I think the paper substantially underestimates the impact of implicit guarantees on dealers. In my view, market participants assign a probability that each dealer is a systemically important financial institution that's going to be bailed out if it gets into trouble with some positive probability. And that's going to be true even if you absolutely ban bailouts in the current law, because laws can be and have been changed around the world as financial crises hit. So, and the market's going to anticipate this, and dealers with higher perceived probabilities will have a competitive advantage in this market. And certainly there are, well, Craig can doubtless cite examples of dealers that have faced the market discipline. Let me give a couple of examples where they pretty clearly haven't. One of them relates to Lehman operations after Bear Stearns collapse is one example of this. The SEC and Reserve Fund, and Reserve Fund has been, primary fund has been talked about several times, but the SEC filed a complaint against some of the officers of Reserve Primary. And as a part of that complaint, they reproduced an email from one of the officers, from the chief investment officer, to one of the rating agencies about the funds holding Lehman papers. And this was just days before Lehman failed. And the rating agency guy said, well, we know you had lots of Lehman paper. Are you still okay with that? And the response came back, oh, we're okay holding what we have. And that he believed that Lehman would, if necessary, be assisted by the federal government. To offer another example, there's a very large bank that's been referenced more than once during the course of this day that's been trading at under $5 a share since 2009. This large bank has tens of trillions of dollars in its over-the-counter derivatives book. If there was no perception that there was any implicit government guarantee, how large do you think that book would be? So I think it's a mistake, again, to think that market participants must assign a probability of either 0 or that they assign a probability of 1, because none of these banks are trading as if they were the Treasury to implicit guarantees. Rather, it's better, I think, to think of it as somewhere between 0 and 1. And let me give an additional reason to think, in particular in the case of derivatives, that's likely to be the case. If a bank is put into resolution, the FDIC has a one-day option to transfer all the contracts with any individual counterparty to another bank, including a bridge bank. That rule exists for a very good reason, and I'm not challenging the rule. Counterparties need to know where they stand, and they can't be left hanging for weeks while it's decided whether the FDIC likes the contract or not. But the result is that the FDIC has no practical hope of understanding a major dealer's derivatives book before they'd have to decide whether or not to transfer the contracts, with the very likely result that the FDIC would retain all the transactions in larger, more complicated books. So what I would do is encourage Craig to rewrite the paper, because in the paper, basically, the dealer faces full market discipline. There's no implicit guarantees in the model itself. There's a fair amount of discussion of implicit guarantees, but there's no implicit guarantees in the model itself. And I would encourage Craig to write a new paper based on a modified version of the model, which assumes a positive probability of bailout of the central counterparty and the over-the-counter dealer. For what it's worth, some of my conjectures about how things would work out in this, a change comparison is that of overtrading. The model shows that a central counterparty incents overtrading by its weak members. The new finding would be with the implicit guarantees provided to weak dealers that in the over-the-counter market they too would overtrade. On the other hand, the case where I don't think that there'd be any change relates to the issue of undertrading. The central counterparty may incent undertrading by the strong issuers if it demands excessive margin. But on the other hand, the paper finds, and I can't think of any reason why implicit guarantees would change this, that the over-the-counter market doesn't create any incentive for undertrading. Beyond that, there's some issues that are not so easily modeled and that Craig talked about at the end of his presentation. Clearly, a new central clearing party creates the potential for a new systemically important financial institution that would get bailed out if it got into trouble. And if you place these activities into an existing one, that might be made more vulnerable to failure. So that's clearly a problem with going that way. On the other hand, expanded over-the-counter operations may increase the bailout probability of a derivatives book by making it more complicated, though for the dealers I'm not sure that that effect is going to be that large. But losses in the derivatives may boost the probability that there's a bailout of the overall dealer. The paper has shows in a kind of a daisy chain of failures where having the dealers hedging with each other actually reduces the risk to the ultimate clients. But the supervisors care about more than just the over-the-counter derivatives markets. They care about the payments processing, for example. So clearly, this is an issue that deserves further consideration. Craig has very effectively demonstrated that the rush to pushing everything onto a central clearing party is not a great idea, that there may be unintended consequences, and as Chester told us at lunch, unintended consequences are just as real as intended consequences.
Craig, do you want to respond to that?
Yes, just briefly. Second here. Although it actually won't.
Yes, yeah.
No, thank you very much for your comments, Larry. And I don't disagree. Sort of the original sin in many of these markets is the implicit guarantees and the implicit guarantees of systemically important financial institutions. What I would note, though, is that I don't really see, for a variety of reasons, that seems in some respects to be a push between the OTC markets on the one hand and sort of cleared structures on the other. The first reason for that is that who are going to be sort of the ultimate bearers of the risk of a central counterparty? It's going to be the same basic financial institutions, so again, potentially bailing out a CCP in order to help out the very same financial institutions, that is something of a push. In particular, I think it's very likely that these new clearinghouses will be essentially implicitly or explicitly beneficiaries of bailouts. It's actually part of the sort of the debate going on over the Senate bill with the Lincoln provisions and so on that would explicitly preclude the Fed, for example, from providing any financial assistance to clearinghouses. But I think, as you noted, these are in extremis, in a crisis. These are things that are more likely to be circumvented than honored. But I do appreciate your comments. I do think it, for sort of making the comparison more complete, it is worthwhile making these issues explicit. So.
Do you have any questions for
Yes.
the question I don't want to make the
So
it seems
It's entertaining.
about AIG was that if they've been required to close collateral, they wouldn't
were subject to collateralization agreements, but basically on a mark-to-market basis. Not at the outset. So there was no initial margin or original amount, as the phrase goes. And so essentially what happened is that their counterparties essentially extended them some credit in the original deals. A couple points to make. I mean, first of all, part of the reason that they did that, and I think part of the reason that a central counterparty, even if one had existed, wouldn't have made that much of a difference, it was because the deals that AIG were doing were perceived to be low risk. I mean, we essentially, we're looking with hindsight bias now as, oh, gee, knowing now what if we could go back to 2005 or 2004 when AIG did these deals, they would have been priced differently. But in 2004, 2005, when these were perceived to be very low risk deals, it's likely that the original amount would have been relatively small and unlikely to have constrained AIG. The other point is I think it's important to take into account the equilibrium responses that Chester also noted in his talk. So essentially what happened was essentially there was a credit component, a extension of credit through the by the counterparties to AIG. Well, so if the counterparties had instead asked for some original collateral, some initial margin, AIG still would have had some debt capacity that it could have utilized to essentially finance that. Given that it had a very large appetite for this kind of risk, it thought it was very attractively priced. It's a very open question as to how much at the margin it would have had an effect on the amount of deals that they did.
The point is there would have been one counterparty that would have novated all $500 billion of the credit default swaps, and that counterparty, namely the central clearing party, would have had to been comfortable with that risk.
Right, but again, I mean, so I just think it's it's highly unlikely that that central counterparty would have been that uncomfortable given what everybody believed at the time. I mean, I just can't think that you can anticipate that a central counterparty is going to be exceptionally prescient, is going to go against the conventional wisdom in particular. I mean, it's sort of essentially everybody believed that this is relatively low risk stuff. Why would the central counterparty be any different? Also, the other part of it is that who ultimately is, the central counterparty is basically the creature of its members. Who would have been the members? Goldman Sachs, Deutsche Bank, I mean, basically the same folks that were, the counterparties in the over-the-counter deals. And it just seems to me, I mean, maybe it could have happened, but it seems to me a real stretch to be confident that a CCP would have treated AIG any different than Goldman or Deutsche Bank or the other counterparties. Yes.
We were talking about implicit and explicit thoughts about whether the CCPs will get bailed out.
Mm-hmm.
And from what I've read, it's more or less explicit that the market is going to be expecting this. Plus, on top of Lincoln's discussions about no bailout, there is a title in the Dodd bill last I saw on Business Week ran a news story on this last week about Sheila Bair
Right.
against her writing some sort of memo that would designate financially significant utilities, clearly a CCP, right? And they would have access to the discount window,
Right.
Fed accounts and other services, but that's also something that could potentially, in a time of insolvency, provide a bailout and something that, we need to be thinking about in terms of these CCPs.
No, absolutely, I agree with you completely. And there are a variety of other issues as well. So, for example, one could argue that what happened on October 20th, 1987 was sort of a liquidity issue. And if you followed the Lincoln bill literally, you would say, well, gee, we can't even provide liquidity support to these sorts of institutions. That seems to be, problematic. But then on the other hand, if you have the possibility of, even when they're insolvent, essentially providing bailouts. So, to me, in many respects, it just seems that we're jumping from the frying pan into the fire, where we're going from one set of interconnected institutions that we think are too big to fail, so we're essentially mandating the creation of another set of interconnected financial institutions that will be too big to fail. Ultimately, how does that really change the incentives from a political economy level at the, when we get into trouble, whether there's going to be a bailout or not?
Craig, I'd like to observe that this question of differential margin rates for different members, perhaps based on their credit profile. I think there's two mechanisms that pretty much cover that. One is the initial membership requirement. requirements. For example, if you look at the membership requirements for the London Clearinghouse, LCH, with interest rate swaps, they're enormous. The firms need to have some huge balance sheet numbers, they have to have some huge numbers of interest rate swaps outstanding in order to even be considered for membership. And the second mechanism is not the margin rates as such, but it's the contribution to the guarantee fund. So as a firm would put more and more business into the clearinghouse, they would be asked to proportionally contribute more to the guarantee fund, not on a daily basis, but perhaps on a quarterly or maybe 6-month basis. And so the other reason for keeping the margin rate the same for everyone, if it were known that members had different margin requirements, then that would probably circle back into the market for exchange traded. And to the extent that it was known that certain members were trading, that would affect the prices in the trading system.
Right. Well, a couple of remarks. I mean, first of all, in terms of having to have a big balance sheet to join, I'll just note that Lehman was a member of the LCH. So, and second of all, I mean, you look at the disparity in CDS prices across different members of the LCH or ICE Trust. There's a substantial disparity. So, those mechanisms really don't address that directly. Also, most clearinghouses, in terms of their contributions and their capital that they have to inject into the CCP, usually it's a multiple or a function of the margin amounts. And so again, if the margin amounts really aren't conditional on their particular credit risk, neither are these capital requirements or additional obligations to put in capital. So, I mean, these are mechanisms that are essentially increasing the amount of capital that you have to get into the clearinghouse and scaling that amount of capital based on how big you are, but it's still not really making distinctions on the basis of your marginal contribution to the riskiness of the clearinghouse. And it's at the margin where I think it's important. Yes, you had a question.
One argument that often comes up here and in other financial debates is that, well, if you have some kind of guarantee function, then you lose market discipline, people aren't doing counterparty credit risk. I'd like to point out that it's not necessarily economically efficient for every party to be doing counterparty credit risk. In order to get the right amount of credit analysis, we only need a statistically significant sample of people doing the right amount of credit risk. So that one of the benefits of an organization like Central Clearing is that it reduces the amount of uncertainty in the system, especially in a time of crisis, in that if you're confident the clearinghouse will survive, you can continue to do business, and you don't have to worry about the counterparty credit risk of all the potential counterparties out there.
Well, I would disagree somewhat. First of all, one argument that you can make is that I thought you were going to go the other way by saying that, well, if we can reduce the amount of duplicative analysis of the creditworthiness by having every counterparty do an analysis of you if they're doing a deal with you by just having the clearinghouse do it, that would be potentially a scale economy that presumably could be captured and provide an incentive to form a clearinghouse voluntarily. Going the other way, which is how I interpret your question, it really doesn't necessarily change the equation that much because, again, who ultimately is the clearinghouse? The clearinghouse is its members. And so there's still a tremendous, so you're really, now you're actually having to see through the clearinghouse to the members to see what their creditworthiness is. And if you go back to October 19th and 20th, 1987, one of the big problems is that because many of the futures commission merchants or members of the Options Clearing Corporation were deemed to be on shaky ground, that led people to view the clearinghouse as being unreliable. And so I was here, I experienced it directly, and there were rumors going around, hey, the clearinghouse is, and so that's actually one of the things that contributed to the crash and the magnitude of the crash in the 19th is that when rumors about the solvency of the clearinghouses started to go around, that was very bad. And so it would be nice if it was, you only have to look at one, but really you have to look through the clearinghouse at its members to understand the credit riskiness of the clearinghouse.
I would think a couple of side benefits that are
figures in your paper, but one would be at least possibly a more efficient use of collateral. You seem to be arguing the other way. I don't quite see that, because if you have a centralized function to take care of the collateral management, that's going to economize on the use of collateral. You don't need all these compression services and stuff to give you half the solution for this. So that's the one thing. And then, depending on how you set up a central counterparty solution, you'll gain an awful lot in terms of trade information, both volume and price-wise. OTC markets remain opaque. And in my mind, one of the reasons you don't see the voluntary clearing solution, because it's resisted by the industry, because they feel that they will lose the handle among the dealer community on the price information that they have that the clients don't have.
Right.
And that would seriously compress spreads,
Right.
bid-ask spreads for them, and therefore take a huge amount of profits away. And that's a big problem, because it gets into the way of getting these voluntary clearinghouse solutions being set up.
I don't want to tread on Martin's time too much, so I'll just try to answer quickly. First of all, yes, potentially there are benefits associated with netting, but those would presumably be private benefits that the market participants could obtain. And it's interesting to look. These were arguments that were raised when the Chicago Board of Trade resisted adopting clearing between 1891 and 1925. They realized that there were these collateral benefits in terms of netting and so on, but they deemed that there were other costs that more than outweighed that. In terms of information, yes, but we can essentially unbundle services. So if you think about a clearinghouse as essentially offering a bundle of services, information might be one of them. That function can be obtained by, for example, having a trade repository, but without having the potentially inefficient risk-sharing aspects of it. So one of the things I've argued in some of my other papers is let's look at the variety of functions that CCPs perform. Are there some of those that can be sort of stripped out in order to improve market efficiency without sort of mandating the entire thing? The other question about competition, I agree that's an important issue, but let's, I'd be glad to follow up on you with that. So, but I don't want to take up too much time.
Okay, so let me ask one last question. So if the OTC market is more efficient at pricing counterparty risk than the centralized clearinghouse, what do you think of this? I came across this paper by Francis Longstaff, who studied how counterparty risk is priced in the OTC CDS market, and he found a very small effect. So what do you think of it?
I think it's a good paper, and there is a small effect. There are other papers that do find that there is, in other markets, for example, interest rate swaps, for example, that it is priced, and it does have some effect on prices. So I would say that empirically there is an effect, but it's probably not that large. But still, the question is, we know that the effect essentially within a CCP is zero. So.